All right, let's dive right in. Today we're unpacking a really insightful analyst report from John Kennedy on Yemeshii called Decoding Tesla's Future Deliveries. Now, you probably saw Tesla's last quarter. It was a record breaker, absolutely blew past expectations. But the big question on everyone's mind is, can they keep that momentum going? Well, this report uses some pretty serious data modeling to look ahead, all the way to 2026. So let's break down what it found.
So yeah, after hitting nearly 500,000 deliveries in just one quarter, the real nail-biter is whether this is the new normal or just the flash in the pan. What does the data actually predict for 2025 and 2026? And maybe more importantly, what does that mean for the company's bottom line? That's exactly what we're here to figure out.
And you know what? We're going to flip the script a little bit here. Instead of making you wait until the end, we're starting with the main event. This is the bottom line, the core delivery forecast, right up front.
Okay, take a look at this. This table is basically the roadmap for the next couple of years. The middle column, the ensemble mean, that's our central forecast. It shows a steady climb from around 507,000 vehicles in late 2025 to over 543,000 by the end of 2026. But the really interesting part? Look at the columns on either side, the conservative and optimistic ranges. Think of it this way. There's about a 10% chance deliveries fall below that conservative number and a 10% chance they shoot past the optimistic one. And you see how that gap between them gets wider over time? That's uncertainty in visual form. The further out you look, the fuzzier the crystal ball gets.
And here's the headline number, the one to really anchor on. The main projection lands just north of 543,000 deliveries for the final quarter of 2026. So keep that number in your head, because now we're going to see exactly how the analyst got there.
So how in the world did we get to that number? You know, a forecast is only as solid as the tools used to build it. So let's pop the hood and take a look inside the analyst toolkit to really understand the horsepower behind these predictions. Here's the secret sauce. Instead of just relying on one method, one crystal ball, this analysis uses what's called a multi-model ensemble. The best way to think about it is, instead of asking one fortune teller, you're getting a whole panel of specialized experts together. Each one has a different perspective, and by combining them, you get a much more balanced and, frankly, more reliable prediction.
And here are our three experts on the panel. First up, you've got ARIMA. Think of it as the historian. It's fantastic at looking at past data to find long-term trends and seasonal cycles. Then you have Prophet, which is like the trend spotter. It's built to handle the kind of explosive, non-linear growth Tesla is known for, and it doesn't get thrown off by weird outliers. And finally, there's XGBoost, the pattern finder. This is a heavy-duty machine learning model that can spot complex relationships and even factor in external data that the others might miss. Now, as you'd probably guess, when you get a bunch of experts in a room, they don't always agree. And that disagreement, well, that's actually where things get really insightful. Let's look at what happens when these data specialists see the future a little differently.
To figure out who to trust, you first have to see how they did in the past. That's called backtesting. These columns, MAE and RMSE, are just fancy terms for error rates. Think of it like a golf score. The lower, the better. And as you can see, ARIMA, our historian, has been the most accurate so far, with the lowest error scores by a pretty wide margin. That tells us that at least up to now, history has been a really good guide for Tesla.
And this chart just lays out their disagreement perfectly for the future. Looking at Q4 2025, Prophet is the big optimist in the room, calling for almost 568,000 deliveries. On the other end, XGBoost is much more conservative, down at 468,000. And ARIMA, our historically accurate model, it's sitting right there in the middle. This disagreement isn't a problem, it's a feature. It paints a realistic picture of the range of possible outcomes.
So what do you do with three different answers? Well, you don't just pick your favorite. You create an ensemble. The final forecast we started with is a simple average of all three models. It's a really smart, stable approach because it smooths out the extreme optimism of one model or the pessimism of another, giving us that balanced, consensus view.
Okay, delivery numbers are great, but for investors, for the market, it's all about what those numbers mean for the business. So now let's translate these vehicle forecasts into what really matters, dollars and cents.
This table is where the rubber really meets the road. It shows how those different delivery scenarios we talked about for Q4 2025 could directly impact revenue and profit. The main forecast, that ensemble mean, points to about $22.6 billion in revenue and almost $3 billion in operating income. But just look at the swing between the conservative and optimistic cases. We are talking about a difference of over $1 billion in profit in a single quarter. And let's just boil that down to one powerful number. $1.22 billion. That is the potential swing in operating income in 1 quarter, depending on whether Tesla hits the low or high end of its forecast. It just goes to show how incredibly high the stakes are for hitting those production and delivery targets quarter after quarter. Now, zooming way out, the analyst also ran what's called a Monte Carlo simulation to get a longer-term view of gross profit all the way to 2030. The median line shows nice, steady growth, from about $18.5 billion up to nearly $28 billion. But again, look at that range, the gap between the 5th and 95th percentile. It just gets wider and wider, showing how that uncertainty really starts to compound the further out you go. So after all of this sophisticated modeling, all these different scenarios, the analysis points to one single, overarching factor that drives pretty much everything else. This is the ultimate key to Tesla's future. And here it is, an R value of 0.80. For those of you who aren't statisticians, that number represents the correlation between vehicle production and vehicle deliveries. And let me tell you, 0.80 is an incredibly strong positive relationship. It basically says that for now, Tesla can sell every car it can make. Demand is in the bottleneck, production is.
And you don't have to take my word for it. The analyst John Kennedy Onyemechi puts it perfectly right here. Production capacity expansion remains the most critical determinant of delivery outcomes. In other words, you can forget about everything else for a second. At the end of the day, it all comes down to one thing: how fast and how efficiently they can build cars in those gigafactories.
So let's just do a quick recap. First, we saw that using a team of models in Ensemble gives a much more balanced forecast. Second, looking back, historical trends have been a great predictor for Tesla. Third, when the models disagree, it's actually useful. It shows us the realistic range of possibilities. Fourth, these delivery numbers aren't just trivia. They have a multi-billion-dollar impact on earnings. And finally, the big one. It all boils down to production. Scaling up manufacturing is the key that unlocks all future growth.
And that leaves us with one last really crucial question to think about. If everything hinges on production, is Tesla's biggest risk an internal one? Things like factory efficiency, supply chains, and scaling up new plants? Or is it an external one, like a slowing economy or new competition? Based on the data in this analysis, the answer seems to lie firmly inside Tesla's own factory walls.